Imagine losing basically 6% of your physical foot traffic, right? Just watching your core working class customer completely tap out.
Yeah, just vanishing from the aisles.
Exactly. But somehow you still manage to expand your profit margins, and your management team gets on the call and celebrates it as this massive strategic victory.
Which is a wild magic trick to try and pull off in this economy.
It really is. And Wall Street absolutely hated it. I mean, the market's reaction was just a violent, undeniable rejection.
Yeah, they dumped the stock.
Hard. Nearly 12% down on the day of the print, just crashing through support levels on massive volume. So, welcome to Talk Tickers. On today's deep dive, we are unpacking one of the most fascinating psychological divides between a corporate management team and the open market that we've seen all season.
It really is a massive disconnect.
Right. We're looking at Academy Sports and Outdoors, specifically their fourth quarter and full fiscal year 2025 earnings call. And management effectively framed this past year as a victorious inflection point.
Oh, yeah, they were pointing to, market share gains, foundational tech rollouts, margin expansion, all the buzzwords.
But the market looked at the plunging foot traffic, an exhausted core consumer, and guidance that left literally zero room for error. And they just hit the eject button. So we're going to break down the mechanics of how this happened.
Because you really can't engineer the bottom line indefinitely when your top line realities are just deteriorating. I mean, financial engineering, supply chain optimization, those are great tools, but they only buy you a finite amount of time.
Right. Eventually the bill comes due.
Exactly. Eventually, if the physical count of human beings walking through those sliding doors keeps dropping, the underlying math of a massive big box retail model just breaks.
Because you have massive fixed costs.
Right. A 70,000 square foot building demands volume, and that's the fundamental tension driving this sell-off. Management is trying to convince the street that they've built this, highly profitable, resilient machine.
While the street is just looking at the raw transaction data and seeing a totally hollowed out consumer base.
Exactly.
So let's put the raw numbers on the table for you, just so you understand exactly what triggered this aggressive institutional dumping. Revenue came in at $1.7185 billion for the quarter.
Which technically is up 2.5% year over year.
Technically up, yeah. But it missed the consensus estimates. The street was looking for something around 1.756 to 1.76 billion.
Right, so a clear top-line miss.
And adjusted earnings per share hit $1.97, which also missed the street's target of roughly $2.03.
So you have a top and bottom line miss right out of the gate.
Yeah, which is always going to invite selling pressure. But the underlying composition of those numbers is where the red lights are really flashing. So comparable sales, meaning locations open for at least a year, fell by 1.6%.
And that's where the story really starts to get dark.
It really does, because the critical, terrifying detail is the transaction data. That negative comp was driven by a brutal 6.4% drop in transactions.
Yeah. A 6.4% drop in physical transactions is an enormous loss of human traffic for a retailer that relies heavily on impulse buys and basket building.
Just fewer carts in the checkout lane.
Exactly. The only reason the top-line revenue didn't look like a total disaster is because that plunge in foot traffic was partially masked by a 5.1% increase in ticket size.
Meaning the people who did show up spent more.
Right. The fewer people who did walk in the door were paying significantly more for whatever they took to the register.
Wait, I need to stop you right there. Expanding gross margins while transactions are plunging 6.4%, that feels mathematically unsustainable to me.
It's definitely a tightrope walk.
Because normally when you see a massive drop in transactions, inventory piles up, right? And then the retailer has to aggressively discount just to clear the channel, which completely crushes margins.
That's the standard retail do loop. Yeah.
But here, gross margin actually expanded. It went up by 140 basis points to 33.6% in the fourth quarter. And for the full year, it hit 34.8%. So how are they not just bleeding out? How exactly do you expand your profit margins while you are literally hemorrhaging foot traffic?
Well, it requires a highly orchestrated, almost surgical manipulation of pricing and inventory. So the primary driver here is the aggressive upward management of AUR, which is average unit retail.
Basically just charging more for the items.
Right. And management successfully forced their AUR up by a massive 10% in the fourth quarter alone. and 6% for the full year.
Oh, wow. 10% in a single quarter.
Yeah, it's huge. And they didn't achieve this by simply slapping higher price tags on the exact same entry-level goods.
Right, because the consumer would completely reject that.
Exactly. Instead, it was this combination of severe promotional optimization, basically canceling those blanket store-wide discount events and relying on highly targeted personalized CRM discounts.
So no more 20% off everything in the store, weekend sales.
Right, no more of that. And they paired that with dramatically shifting the physical assortment toward premium brands, which naturally just carry higher structural price points.
Okay, I hear that, but 10% in a single quarter is still a massive price hike for any consumer base to absorb, regardless of the brand mix.
It is. It's a heavy lift for the consumer.
They also had some significant tailwinds on the cost side to make that 140 basis point expansion happen, right? Like lapping those severe port disruption costs from the prior year.
Yeah, thankfully those didn't repeat.
And their logistics teams managed to find some genuine structural efficiencies in their domestic transportation network. So the cost to move a shipping container actually went down, while the price they sold the shoes for went up.
Which is great for the P&L in a vacuum. But the problem with that equation is sitting directly on the balance sheet. If you look at the inventory line item, it ballooned to $1.5 billion.
Oof, that's a big number.
It's a 14.9% year-over-year increase. And when you break that down on a per-store basis, the inventory dollars were up 6.3%. But the actual physical units of inventory were completely flat.
Wait, so they don't have more physical items in the back room?
Not at all. The items they're holding just cost significantly more to keep on the books. That is the mathematical proof of that product cost inflation and those higher AURs.
So they're just holding more expensive stuff.
Exactly. And holding $1.5 billion in highly seasonal, trend-dependent sporting goods inventory is a massive liability, especially if the consumer suddenly decides to stop buying premium gear.
Which brings us to the most jarring piece of internal data they released. Because if you look at who is actually shopping, you see this violent bifurcation in the consumer base.
It's literally two different worlds.
Yeah. The sub-$50,000 household income cohort, which, let's be honest, has historically been the absolute bedrock of this company's core demographic, they saw high single-digit traffic declines.
They are effectively vanishing from the ecosystem.
Yeah. Just getting crushed by macro pressures. You've got high gas prices, a tough job market, and a reality where credit card delinquencies have essentially doubled year over year.
Yeah.
This lower-income consumer is completely tapped out.
Totally out of gas.
Yet, at the exact same time, traffic from households making over $100,000 a year actually grew by 10%.
And that demographic shift fundamentally alters the entire risk profile of the business. You have the 100K plus earner who, might normally shop at a high-end specialty running store or a premium boutique trading down.
Or just migrating to the big box sporting goods store to buy their premium brands.
Right, which drives that 10% growth.
Yeah.
They are the ones actually absorbing those 10% AUR increases without flinching.
Okay, but a massive big box footprint is structurally built for volume, isn't it?
Absolutely. It requires density. It requires that working class family coming in on a Saturday to buy youth cleats, a cooler, a pack of tube socks, and some fishing lures, all in a single massive basket. If you lose that consistent volume-driven foot traffic, you lose the operating leverage that keeps the lights on in a massive facility.
So I have to question whether this is like an intentional gentrification of their customer base or just a desperate accident. Because management is bragging about the margins on high-end gear while completely ignoring that half the aisles are empty because the neighborhood locals can't afford to shop there anymore.
It's a really dangerous game to play.
It feels like a restaurant bragging about their incredible profit margins on a $100 steak while completely ignoring that half their tables are empty. I mean, if transactions are down 6.4% and inventory dollars are up nearly 15%, aren't they just stuffing the channels? They're just stacking expensive inventory and raising prices until their core working class customer simply breaks.
Yeah, and the harsh reality is you cannot indefinitely offset an exodus of your core customer just by selling more expensive items to a wealthier cohort. Eventually, you hit a ceiling on pricing power.
Right, because the 100K earner isn't immune to economic gravity either.
Exactly. They just have a longer runway before it hits them. If the broader economy tightens further, that upper income cohort will absolutely stop buying $200 elite fitness shoes. And because the value customer has already abandoned the store, the revenue floor completely falls out.
Bottom just drops.
Right. And management recognizes this vulnerability, which is exactly why they are desperately pivoting to these internal operational levers.
What they refer to as their self-help strategy.
Right, they call it self-help to basically signal to the street that they can force growth without relying on a macroeconomic miracle.
Well, let's dig into the self-help arsenal because they are spending an absolute fortune to upgrade their operations right now. It touches physical real estate, digital infrastructure, in-store technology, basically everything.
They are opening the checkbook for sure.
Yeah. Despite the soft traffic, they are heavily expanding the physical footprint. They opened 24 new stores in 2025, and they have another 20 to 25 massive locations planned for 2026. And the capital expenditure math on this is staggering.
It really is.
They're looking at roughly $2.5 million to $3.5 million in net capex per store, targeting a 20% return on investment.
Now, to be fair to management, their real estate selection has historically been very solid. The stores they opened between 2022 and 2024 are currently comping positively in the mid-single digits. So the newer vintages are actually performing.
Okay, so the recent track record is okay.
Right. But opening 25 new stores directly into the teeth of a severe discretionary spending slowdown, that is a highly aggressive deployment of capital.
It feels risky.
It is. They are betting that these new stores can act as localized fulfillment centers for their growing e-commerce business, and that infilling these existing geographic markets creates necessary brand density.
I just struggle to see the logic of aggressively building out brick and mortar when the true growth vector is clearly digital. I mean, their e-commerce business was a major bright spot, right? It grew 13.6% in fiscal 25.
Yeah, digital was a massive win for them.
And they aren't just coasting on a basic legacy website either. They are rolling out some highly sophisticated tech. They're deploying agentic AI, including an AI shopping assistant named Scout.
Right.
And they're moving to a fully AI-based semantic search platform in the second quarter of 2026.
And that semantic AI piece is fundamentally different from legacy keyword search. It really has the potential to drastically shift conversion rates.
How so? Like, what's the actual difference for the user?
Well, historically, if a customer searches for blue running shoe size 10 and makes a typo, they get 0 results. The system just fails.
Right. You just get the no items found page.
Exactly.
Yeah.
But a semantic vector database actually understands intent. It understands context.
Oh, interesting.
Yeah, so the user can type something complex like, I need shoes for a muddy trail marathon next week in cold weather. And the AI essentially acts as a highly trained digital floor associate.
So it curates an entire outfit.
Right. It curates a personalized landing page with trail runners, thermal socks, and hydration packs all instantly. It shifts the digital experience from a static catalog to a digital concierge. And if they execute that correctly, it drastically reduces bounce rates and drives up the units per transaction.
That makes a ton of sense. So that explains the digital side of the spend. But they also made a massive capital expenditure inside the physical stores with RFID technology.
Oh, the RFID rollout is huge.
Yeah, they've now deployed radio frequency identification scanners into all of their stores, covering brands that represent about 25% of their total annual volume.
It's a game changer for operations.
And I really want to get into the actual physics and labor mechanics of this, because to a casual observer or, a retail outsider, a scanner just sounds like a minor supply chain tweak. But the operational reality of RFID completely rewrites the labor model of a big box store, doesn't it?
It absolutely does.
Yeah.
I mean, before RFID, inventory visibility was essentially just a guessing game.
Oh.
A store might conduct a manual physical inventory count once a year, right? They pay a third-party crew to come in and scan every single barcode over a weekend. Or they rely on these highly inaccurate cycle counts.
Which are out of date almost immediately.
Exactly. The degradation of inventory accuracy between those counts is massive. So a customer asks an associate for a specific size. The legacy inventory system says there's one in the back room.
And then the associate disappears for 20 minutes.
Right. They spend 20 minutes searching through totally disorganized cardboard boxes. They can't find it. The customer gets annoyed and the sale is lost.
We've all been there.
Right. But with passive RFID tags, an associate simply walks through the store and the back room with a handheld reader that captures the radio waves from hundreds of items per second.
Wow. Hundreds per second.
Yeah. So they are now executing weekly, automated, highly accurate inventory counts.
Which completely eliminates that let me check the back friction entirely. And because of this singular technological rollout, their in-stock rates improved by a massive 500 basis points. That directly translates to higher conversion because the product is actually sitting on the shelf in the right size exactly when the customer is ready to buy it.
And it goes even further than that. Management expects this to turn shrink, which is the retail terminology for theft, loss, and administrative error, into an actual financial tailwind in 2026.
Wait, a tailwind? How does shrink become a tailwind?
Because they can identify missing items instantly. They don't have to wait a year to know something was stolen, so they can dynamically adjust their replenishment orders and avoid out-of-stocks on high-theft items.
Oh, so they just reorder it immediately so the next paying customer can actually find it.
Exactly. It saves the revenue that would have been lost.
Okay, that's incredibly smart. But the problem with this entire self-help arsenal, the semantic AI, the RFID rollout, building 25 massive new physical stores, is that it is incredibly expensive to build and maintain.
It's a huge drag on the P&L right now.
Yeah. SG&A selling, general, and administrative expenses hit 23.7% of sales in the fourth quarter. That is a 70 basis point increase year over year. And management openly admits this expense bloat is largely driven by the heavy costs of this aggressive operational rollout.
Which brings up a massive structural contradiction in their strategy.
Yeah.
Think about it. They are rolling out sophisticated AI semantic search to dominate online. They are expanding endless aisle drop shipping so you can buy anything from a vendor's warehouse.
Right.
But at the exact same time, they are spending tens of millions of dollars a year to open massive physical stores while their legacy foot traffic is dropping 6.4%.
It's totally paradoxical.
Right. I just don't buy that this is a durable omni-channel algorithm. It really feels like they're just buying top-line revenue through geographic expansion at the severe expense of their operating leverage.
And that is the exact bear thesis that drove the 12% sell-off, right? I mean, are they building a sustainable, interconnected retail ecosystem, or are they just running on an incredibly expensive treadmill, forced to keep building new stores just to mask the fact that their legacy locations are bleeding customers?
Exactly. If the core consumer continues to pull back, adding millions of square feet of new physical retail space is a highly leveraged, potentially disastrous risk.
Because if you are spending tens of millions building these massive new physical stores while your core customer is literally going broke, you have a massive problem. You have to invent a completely new, compelling reason for them to come back inside the building.
You have to force them back in.
Right. And that is exactly where this highly aggressive credit card strategy comes into play. To make sure those expensive new stores actually have loyal shoppers in the aisles, the company is completely overhauling how it rewards its customers. They are launching a massive loyalty play right before the crucial Father's Day shopping season.
This is one of the most interesting parts of the call, because they are currently sitting on a massive, highly valuable base of 13 million members in their existing My Academy Rewards program.
13 million is a lot of data.
It's a ton of data. And in the second quarter of 2026, they are tearing that legacy program down and completely relaunching it as a new integrated 3-tier ecosystem.
Okay, walk us through the tiers.
The mechanics are designed to capture every possible level of consumer engagement. Tier 1 is the frictionless base program. No credit card required. You just hand over your email and phone number, you get $15 off your next purchase, and you unlock free shipping on digital orders over $25.
So that's just a pure data capture play to feed their new AI marketing algorithm.
Exactly. Now, Tier 2 is the private label credit card, which can only be utilized inside their specific retail ecosystem. It offers 5% off in-store and online, free shipping with absolutely no minimum order size, and a $30 sign-up bonus.
Okay, so that's pretty standard retail credit architecture, nothing crazy there.
Right. But Tier 3 is where the financial engineering gets completely wild.
Let's hear it.
Tier 3 is the crown jewel. It is a brand new co-branded MasterCard.
Yeah.
You get all the benefits of the lower tiers, but here is the massive hook. You earn 2% cash back on all purchases made entirely outside of the sporting goods store.
Wait, outside the store? Like where?
Specifically targeting mandatory everyday spend like groceries and gas.
Oh, wow. Okay.
Yeah. But those rewards can only be redeemed inside the sporting goods store.
Oh, that is a masterclass in defensive behavioral economics.
It really is. Management is looking at the macroeconomic data. They know that inflation on basic necessities, gasoline, eggs, milk, is just eating their core customers' entire paycheck.
Leaving absolutely zero discretionary income for baseball gloves or camping tents.
Right. And they know they cannot stop the customer from spending their entire paycheck at the supermarket. So they have engineered a financial vehicle to capture the exhaust from that mandatory spending.
That's brilliant.
If a working class family puts $1,000 a month of groceries and gas on this new MasterCard, that generates $20 in locked rewards that must legally be spent inside the sporting goods ecosystem.
So it artificially forces foot traffic right back into the physical stores.
Exactly.
I look at this structure and I see a financial Trojan horse. I mean, they are effectively inserting themselves right into the middle of the consumer's pain. They are taxing the customer's mandatory grocery bill with a 2% kickback just to subsidize their next pair of sneakers.
That's exactly what it is.
But I have to push back hard on the execution risk here. The theory is brilliant, sure, but we are looking at a consumer base where credit card delinquencies are literally doubling. Interest rates on these co-branded retail cards routinely push 30% APR.
Oh, they are punishingly high.
Right. So does a financially stressed, tapped-out consumer making under $50,000 a year really want to submit to a hard credit check and take on another high-interest MasterCard just to get a slight discount on a hard-sided cooler?
That is the exact friction point. The friction of acquiring a new credit card customer in this specific macroeconomic environment is immense. The approval rates for subprime and near-prime applicants are tightening across the entire banking sector.
So a lot of them might just get denied anyway.
Right. So they're going to have to market this incredibly aggressively, leveraging massive point-of-sale pressure from the cashiers and big sign-up bonuses just to break through the consumer fatigue.
Would you like to save $30 today?
Exactly. Furthermore, there is a massive balance sheet implication here. When you issue points that can only be redeemed for merchandise, you create a massive liability on the corporate balance sheet.
Oh, right, because it's unredeemed value.
Yeah. If millions of consumers accumulate these grocery rewards but delay spending them, the company has to hold that financial liability, which complicates their cash flow forecasting. But if they can convert even a fraction of those 13 million existing loyalty members into active MasterCard holders, it creates this sticky, recurring revenue loop that is artificially insulated from broader discretionary slowdowns.
Okay, so let's assume the Trojan horse works perfectly. Let's assume the friction is overcome, the cards are issued, and they successfully force the customer back into the store using those grocery rewards. What exactly are these customers going to buy?
That's the million-dollar question.
Because the physical manifestation of the store is shifting dramatically. They are actively chasing that higher income demographic, completely changing the merchandise mix to cater to the 100K plus earner.
Yeah, the merchandising strategy is heavily skewed toward premium, higher price lifestyle brands right now. The absolute standout winner for the year is the massive integration of Nike and the Jordan brand.
Which is huge for them.
Huge. They initially launched the premium Jordan shop-in-shop concept in 145 doors last spring. It was so successful that they are now aggressively expanding that concept into 55 more locations, bringing the total to over 200 doors.
Wow.
And the results validate the strategy. Taken together, Nike and Jordan grew in the high single digits for the entire fiscal year.
That is incredible growth for legacy brands at that scale. And it isn't just footwear, right? The work and Western wear category is surging, driven by premium, highly durable brands like Carhartt, Wrangler, Ariat, and rapidly growing newcomers like Hui and Brunt.
Yeah, work and Western is a really strong category for them.
And then you have the fitness category, which really highlights a massive strategic pivot. They secured the exclusive United States brick-and-mortar retail partnership for Hyrox.
Which is fascinating.
Yeah, rolling out exclusive training gear to 70 doors. And for those who don't know, Hyrox is this globally surging fitness racing phenomenon that combines distance running with heavy functional workout stations.
Right, sled pushes, wall balls, that kind of thing.
Exactly. And it attracts a highly dedicated, aggressively high-income demographic that is willing to spend massive amounts of money on specialized marginal gain equipment.
You also see this premiumization happening in the baseball lifestyle category. It's driven by niche, high-end brands like Bruce Bolt and Baseball Lifestyle 101, which are moving massive volume at significantly higher price points than legacy sporting goods brands.
Bruce Bolt batting gloves are not cheap.
No, they're premium. But this aggressive shift toward premium merchandise creates a really stark contrast with the categories that are severely underperforming.
Right, because the softness in the fourth quarter was heavily concentrated in the exact categories that traditionally appeal to their legacy, value-driven base.
Exactly.
Ammunition sales were down, though management claims the category is finally beginning to stabilize after a long post-pandemic hangover. Winter outerwear and boots were incredibly soft, heavily impacted by the lingering cost inflation from tariffs and highly irregular weather patterns.
Yeah, the weather was a huge factor.
And the ride-on category, those large plastic-wheeled toys for kids, which is a massive holiday volume driver for working-class families that struggled heavily.
It's also really worth noting the specific weather anomaly that severely damaged the fourth quarter numbers. In late January, severe winter storms swept across their core geographic footprint in the Sunbelt.
Ice storms, right.
And it forced roughly half of their entire store base to completely shut down for 2 to 3 consecutive days.
Half the stores. Wow.
Yeah. Management estimates that this singular weather event sliced a full 100 basis points off their fourth quarter comparable sales.
Okay, look, you cannot control a January ice storm. That's fair. But you absolutely can control your corporate identity, and this is where I see a massive unresolved crisis. Management swears up and down on the record that they are fundamentally a value retailer at their core.
They say it on every call.
They insist they are staying true to their roots. But look at the physical evidence inside the building. You are rapidly expanding glossy premium Jordan boutiques. You are dedicating prime floor space to elite Hyrox functional fitness training gear. You are pushing premium Bruce Bolt batting gloves.
Right.
Meanwhile, the sub 50K demographic is literally fleeing the store because they can't afford the basket. Aren't they implicitly abandoning their identity? Like, can you actually maintain the credibility of being the destination for a $150 elite running shoe A&D, the absolute cheapest pack of white tube socks in the exact same building?
It is the most dangerous tightrope walk in modern retail. You are attempting to be all things to all people across an incredibly widening wealth gap.
Which seems impossible.
Well, management's thesis is that by offering a strict better and best assortment alongside entry-level goods, they can capture a massive share of wallet from the higher income shopper trading down from boutiques, while theoretically still providing a price floor for the value shopper.
But theoretically is the key word there.
Right, because the psychological risk is immense. Retail environments are highly emotional spaces. If the value customer walks through the automatic doors and the very first visual cue is a massive, high-end, brilliantly lit Jordan boutique, the immediate psychological response is, this store has become too expensive for me.
Oh, 100%.
Even if there is a massive clearance bin of cheap socks in the very back corner, the atmospheric cue has already alienated them. They just turn around and go to a deep discount retailer instead.
It's the physical manifestation of the wealth gap inside a single big box store. It is a delicate, potentially explosive balancing act. And this exact tension chasing premium brands while desperately trying to maintain volume sets the stage for their highly controversial 2026 guidance.
Which is the catalyst for the crash.
Exactly, because ultimately the numbers they put on the screen are exactly what triggered the market's violent sell-off. So let's examine the investor context and look closely at the catalyst map they laid out to defend their projections for the next 12 months.
The institutional investors were looking for absolute reassurance that the bleeding in foot traffic had a floor. They wanted safety.
And what did they get?
Instead, management handed them a mathematically precarious razor-thin roadmap. The guidance for fiscal 2026 projects net sales between $6.175 billion and $6.355 billion. They estimate comparable sales to land anywhere from negative 1.0% to positive 2.0%.
Meaning the exact midpoint of their comp guidance is a microscopic positive 0.5%. They're literally guiding for a mathematically flat year.
Right. And adjusted EPS is guided to a range of $6.10 to $6.60, which sat uncomfortably below the consensus estimates the street had already built into their models.
So the market looked at that flat comp midpoint, looked at the EPS range, missing expectations, and just immediately hit the eject button.
Exactly. But management refuses to back down. They insist they can hit these numbers based on 3 major external tailwinds, which they mapped out as their core catalysts for the year.
Okay, let's hear the catalysts.
Catalyst number 1 is the expectation of higher tax refunds. They are heavily banking on an influx of consumer cash hitting the market in the first quarter to revive that dormant sub-50K demographic.
Banking on the IRS.
Pretty much. And to be completely objective, management noted that the first 7 weeks of Q1 have already started with a slightly positive comp, which they directly attribute to this early refund dynamic.
Okay, an artificial one-time injection of government cash helps the first quarter, sure. But what is the durable catalyst for the rest of the year?
Catalyst number 2 is the massive logistical reality of the 2026 World Cup. The tournament is coming to North America, and approximately 30 specific matches will be played in massive stadium venues located directly across this retailer's core physical footprint.
Oh, right, because they're heavy in the Sun Belt.
Exactly. Management is explicitly modeling a 30 basis point tailwind for the entire year solely from this event. They are anticipating a massive surge in licensed international team gear, a spike in outdoor tailgating equipment sales, and a subsequent multi-year spike in youth soccer participation driving equipment sales.
I understand the geographic advantage. I really do. If the matches are literally in your backyard, you are the default destination for the jerseys and the cleats. But stocking licensed international gear requires massive lead times.
Months in advance.
And it comes with severe inventory risk if a specific team gets knocked out early in the group stages. If a popular team goes home early, you're stuck with millions in dead inventory.
That's a huge risk. And the third catalyst number 3, is America's 250th anniversary. They are banking on a massive, countrywide summer surge in patriotic red, white, and blue merchandise and general outdoor tailgating gear as the country celebrates the semi-quincentennial.
The 250th.
Yeah. They believe the sheer cultural momentum of the event will force people outdoors and into their stores to buy grills, coolers, and licensed apparel.
Tax refunds, a global soccer tournament, and patriotism. It sounds like a fantastic summer party, but I am looking at the macro threats offsetting these events, and they are incredibly severe.
They're looming large.
Yeah. Prolonged spikes in gas prices directly drain the exact dollars needed to buy that tailgating gear. Severe tariff pressures are expected to hit the supply chain in the first half of 2026, which will immediately inflate the cost of goods sold and pressure those precious gross margins. And broadly, you are still dealing with a fundamentally exhausted, credit-strained middle-class consumer.
It's an uphill battle.
So if we connect this to the bigger picture, synthesize this reality for us, why did Wall Street look at this exact setup, the World Cup, the tax refunds, the patriotic summer, and still aggressively dump the stock down nearly 12%?
Because the sporting goods retail space is deeply bifurcated right now, and the market has absolutely zero tolerance for operational execution risk. If you look at the sector reality, this specific stock has badly underperformed both the broader market, as measured by the SPY, and the specific retail sector ETF, the XRT, over the last month and quarter.
They've been lagging.
Badly. The guidance management provided leaves absolutely zero margin for error. The market dumped the stock because the growth algorithm is far too fragile.
Too many things have to go perfectly right.
Exactly. If the World Cup bump doesn't materialize exactly as planned, maybe international tourism is lower than expected, or the U.S. team exits early, leaving millions of dollars of licensed gear dead on the shelves, or if gas prices tick up just 20 cents a gallon, or if the friction of the new MasterCard rollout stalls, the entire year's growth narrative instantly collapses back into negative territory.
That's a house of cards.
Right. Wall Street is loudly saying, we are not going to pay a premium multiple to wait and see if a soccer tournament and a summer holiday can miraculously overcome a structurally tapped out consumer.
The extreme fragility of that growth algorithm brings us to the most anticipated part of the deep dive. We have looked at the raw data, we have deeply analyzed the psychological disconnect between management and the market, and now it is time to map out how to theoretically trade this chaos.
This is where it gets fun.
Yeah. I am going to pass the floor over, and we are going to pitch an outrageous but plausible trade idea based entirely on the specific mechanics and catalysts we just discussed. Let me be abundantly clear to you listening. This is purely an intellectual exercise. This is absolutely not financial advice. Do your own research, manage your own risk.
Do not trade based on a podcast.
Exactly. But if you were a hedge fund analyst pitching to an investment committee right now, looking at this massive sell-off and this specific catalyst map, how are you trading the setup?
The market has completely mispriced. The geographical, technological, and socioeconomic realities converging over the next 12 months. We are executing what I call the patriotic pair trade.
Okay, I love the name. How does it work?
We are going long on this specific big box value retailer, and we are heavily funding that position by shorting the premium, high-end, mall-based athletic retailers.
A structural pair trade based on consumer migration. Walk us through the exact mechanics of the setup. Why are we aggressively taking the other side of a 12% sell-off?
The setup relies on the concept of forced consumer migration. The market has severely overpunished the guidance of the big box retailer. They have priced the stock for a permanent structural decline.
Pricing it for death.
Right. But simultaneously, the market is treating the high-end, mall-based athletic wear brands as completely invincible. assuming the high-income consumer will never experience fatigue. We are betting heavily against that consensus. We are betting on a perfect storm of Sunbelt foot traffic converging precisely in the second and third quarters.
Break down the mechanics of the storm. How do the catalysts actually force the migration?
Look at the exact timing on the calendar. The 2026 World Cup and America's 250th anniversary are hitting exactly when the new aggressive MasterCard ecosystem drops.
You're right, in the summer.
Yeah. If the middle-class consumer is truly stretched to the breaking point by inflation, as the transaction data clearly suggests, what actually happens behaviorally? They do not stop spending entirely. Human nature dictates that they still want to participate in massive cultural moments.
Right, they still want to watch the game and have a BBQ.
But they migrate. They will abandon the $150 premium yoga pants at the friction-heavy, expensive mall brands. Instead, they will migrate to the value-driven, geographically advantaged, big box footprint.
Because of the financial Trojan horse we discussed earlier.
Precisely. They are going to use that 2% grocery and gas cashback generated from the new MasterCard to completely fund their World Cup jerseys, their kids' soccer cleats, and their summer tailgating gear.
Wow.
We are not betting on a booming, healthy macro economy. We are specifically trading the forced migration of the middle-class discretionary dollar away from the expensive mall and into the massive value-driven ecosystem that is actively subsidizing their discretionary purchases with necessary grocery rewards.
That is a fascinating angle.
The market firmly believes this big box retailer is dying. We believe they are building a massive gravitational pull that will suck the absolute oxygen out of the premium mall brands this summer.
Trading the forced migration of the discretionary dollar, it is incredibly aggressive. It relies heavily on the flawless technological execution of that credit card rollout. But structurally, the behavioral economics make a terrifying amount of sense.
It's all about incentives.
Yeah, if the consumer is drowning, they will swim to the raft that subsidizes their groceries. Again, absolutely not financial advice, but a brilliant, highly contrarian way to look at the chessboard when the rest of the market is just panic selling the headline numbers.
It is entirely about anticipating exactly where the stressed consumer has to go to financially survive the summer.
Which brings us to the end of our analysis. To synthesize everything we have covered, you are looking at a massive physical retailer that is aggressively attempting to build out a modern, AI-driven, omnichannel infrastructure.
They're trying to modernize quickly.
Yeah. They have incredible RFID tech optimizing the stores. They are landing massive premium partnerships like Jordan and Hyrox, and they have a brilliant psychologically manipulative loyalty program launching to capture grocery spend. But they are actively battling a deeply exhausted core consumer, severely negative physical foot traffic, and a highly skeptical institutional market that is violently punishing them for relying on a soccer tournament to save their flat guidance.
It is the ultimate high-stakes test of internal operational execution versus the crushing gravity of macroeconomic reality.
And I want to leave you with one final provocative thought to mull over as you watch this specific stock navigate the next 12 months. We talked extensively about the tension of the restaurant, the glossy high-margin menu versus the empty tables.
Right.
If a massive legacy retailer successfully replaces its lower-income core customer with a higher-income demographic, if they successfully swap out the working-class family buying cheap socks for the high earner, buying a $200 Hyrox-weighted vest, is that actually a successful corporate turnaround?
That's the real philosophical question.
Or did management just build a completely new, entirely different company inside the hollowed-out shell of the old one? And if it is a completely new company, should the market value it based on its historical legacy or on a premium future that its original foundational customers can no longer afford to participate in?
It's a total identity shift.
Think about the ship of Theseus, but applied to a 70,000 square foot sporting goods store.
That is the multi-billion-dollar question that will ultimately define the valuation.
A massive thank you for joining us today on Talk Tickers. As a final absolute reminder, nothing discussed in this deep dive is financial advice. We are simply unpacking the narratives and the mechanics hidden inside the corporate numbers.
Thanks for listening, everyone.
If you enjoyed this breakdown, make sure to subscribe and please share your thoughts with us on where you see the physical retail landscape shifting as the consumer evolves. Until next time, keep your eyes on the data and your ear to the tape.